Hey, how are you today? This is Josh Patrick, and you're at Cracking the Cash Flow Code. My guest today is Philip Arthurs, and Philip has a company which I'm drawing a blank on, but it's right here. It's the Business Miner. It only takes me a little bit of time to get my stuff up right. And he has done lots of businesses. He's an investor, an entrepreneur, a CPA, and an evangelist for acquisition, which is what we're going to talk about today, because we're going to have a very lively conversation where he's going to try to convince me that acquisitions actually are a good thing to do. The reason I'm against this is I've done a bunch of acquisitions. Very few are actually worked well for me. Most of them were gigantic failures. And the research shows that about 75 to 80% of acquisitions are non-accretive, which means they don't make money for the acquirer. So let's bring Philip on. Hey, Philip, how are you today?
Hey, I'm doing well, Josh. Thank you for having me on your show.
My pleasure. So, Philip, you're a fan of acquisitions. I am not. I'm a fan of organic growth, by the way, to let you know.
Okay.
So, why do acquisitions make sense, first of all?
Well, when I look at a startup, when you're doing a startup business, there is a lot of work that goes into that, and you have to build out your systems and your processes. You have to hire people, may have to fire people. Then you're having to go out and be the salesperson. You're having to be everybody, and you're missing a very important piece, which is one of the top reasons businesses fail, is that cash flow. If you don't manage your cash flow well, you're not likely not going to stay in business, right? So it causes a cash flow issue because you're trying to work in all different areas of your business as well as uh, try to go out and find new business. So
Yeah, starting from scratch is really, really hard. So,
yeah,
I'm assuming when you're talking about acquisitions, you're talking about how to get yourself into business, not how to grow your business.
I am talking mostly about how to get yourself into business. Now, if I give you some background why, what led me to here, maybe that explained, but
Sure.
I'm a CPA by trade and worked for some of the top CPA firms in the country, did consulting work, did turnaround work. We would turn around failing businesses. And then I did some transaction advisory work. My largest client at the time hired me on as their CFO, and we helped them, me and a team that I helped assemble. We helped grow that company's revenue 240%. Also increased their EBITDA, their cash flow of the business by 500%, and this was all in less than 5 years. So, big part of our strategy there was acquisitions. Now, that wasn't the only strategy, but that was a big strategy. We actually first sold off a bunch of stuff, and then we started buying. So we sold off stuff that was not producing well, and then we started buying. And we got some economies of scale there just from buying the businesses that fit our company well. So I would say I like it as a growth strategy, and I also like it as a start. Your first entrepreneurial experience is buying a business, but there's a lot of, I caution some people on that. You have to have some sort of experience in that industry or management experience. There are some challenges, some hurdles for people to get there. But once you've met those first few hurdles, I think it's a very, uh, it puts you on the fast track towards business success, in my opinion.
I would probably agree that if you were going to start from scratch and you can buy a business, you can buy it at the right price, which is a really big deal.
Hmm.
I see most folks who buy their first business dramatically overpay for it. And because the way the deal is structured is typically, 50, 60% down, and then owner financing for that 30 or 40 or 50%. Now, if you're buying your first business, you're likely not buying a multi-million dollar business, although you could, but you're probably buying a business that does under $1 million.
Right.
And the challenge comes in if you're paying too much money for this, and it's more of a challenge for the seller than the buyer, is buyers tend to stop paying sellers when their business doesn't perform as well as it should and they pay too much money for it. Have you ever run across that problem?
I've not run into it personally. I've heard, but I've never personally run into that. But I think that's part of if you're going to buy a business, that's part of the reason why I would want there to be some sort of seller financing involved at some level, to keep the seller with some skin in the game, so they're not hooking you to a sinking ship.
Yeah, it's what I tell sellers all the time. I do a fair amount of consulting with people who want to sell their business,
Mhm.
and I say your goal is to hold no paper, because the truth is often buyers stop paying for tons of reasons. And frankly, if I sell my business, I've lost all control over it. I mean, if you buy my business and screw it up, and 30% of your business goes away because you didn't know what you were doing, why should I be the one that bears the penalty for that?
Yeah, and I totally understand that argument. But if you're representing a seller, I'm representing a buyer, I'm going to tell them, you know, you're going to want some level of financing, owner financing in that arrangement. Um, because I do think there are a lot of people, the sellers, they over exaggerate their numbers, or maybe they fudge some things and are dishonest. I mean, some of them are just downright dishonest, and it's a big purchase, right? And especially if you use SBA financing, now you're talking about having your house on the line, which could happen in conventional as well. But a lot of people who are just getting into this, they want to use SBA financing, try to get in at 10% of the value. And out of pocket, and then the rest with the SBA and seller financing. And yeah, I would feel better personally, me having some sort of, even if it's just 10-20%, just so that they have some skin in the game still. And if they're unwilling to do that, I almost look at that as a sign that, maybe they don't believe in the business as much.
Well, you might look at it that way. You might look at it, which is the way I look at it, which is you're going to buy the business. You have total control over the business. I have no control. And why am I taking a risk that you're going to do a good job with the business you're buying from me? That was sort of the attitude when I sold my food service and vending
Sure.
company. We got 98% of our business, our sale in cash. And the reason was, so look at due diligence is for you to figure out what might not be right there. You guys have been stalking me now for
Sure.
years.
Yeah.
If you
I
don't
get
know
it.
my business now, I am not about to, play this game, because frankly, I haven't. If you want to give me control over the business after you buy it, and then we can talk about that. But you're not going to want to do that. And frankly, I'm not especially interested in backing up your stupid decisions.
There's also tax advantages for the seller too, to spread out their payments over a longer period of time. So there's an
Yeah,
advantage
yeah,
to them at
yes,
that
and
point.
I mean the tax advantages are there, but I mean I'm going to pay 15 or 20% in capital gains, whether I do it in 1 year or 10 years. It's still going to be 15 or 20%.
Right.
I just pay a bigger number, but I also get a bigger check at the end of the day. And I mean, if you're around the M&A world a lot, um, investment bankers will often say the only money you can count on in a business sale is the cash you get at closing.
I
Everything
agree.
else after that is, well, okay, maybe I'll get it, but I mean, I used to write a blog for the New York Times, and I wrote a bunch of articles for the Times about people who sold their businesses and never got paid. I've even seen things where people sold their business, ended up having to take money out of their pocket because they allowed themselves to stay on as corporate officers. And the buyers screwed up the business so badly, they got in trouble with the regulators. And the ex owner, who was the seller, had to pay the fines to the state.
Wow.
So,
Well, so I want to help people become qualified buyers, and I want
okay,
to,
good.
that's the whole part of what I'm trying to do here, is help people understand how do you be a good buyer, and what can you do to prepare. Certain people probably don't need to be buying a business right now. And if somebody comes to me and says, "Hey, I want to buy this business," I'm going to ask them a few questions. And, if I might say, I think you need to wait a little while, right? If they have no management experience, I say, well, stay in your job, ask your boss, what does it take to be in a management position, and work for that, and have experience managing people, and learn how to read a financial statement, and little things like that are important. And I'm also going to ask people, do you have the stomach to fire somebody? If you had to fire somebody, could you stomach that?
Yes.
If you had, do you have the stomach to not pay yourself when payrolls due? You got to pay your people before you pay yourself. So there's some hard decisions that have to be made as an entrepreneur. And, uh,
So if I come to you and I say, Philip, help me figure out what I need to do to buy this business. What are the top 3 to 5 things you're going to tell me I need to do?
Well, first of all, I'm going to ask, well, what do you want your life to look like? How involved do you want to be in the business? Somebody that comes in and says, well, I don't want to be involved at all, I think that's a huge red flag. So,
Yeah.
but outside of that, understand how to read a financial statement and a cash flow statement.
Cash flow statement is absolutely key.
That's
And
right.
I will tell you that I don't think there's more than 2% of business owners in the country that could read a cash flow statement.
I would even say that there are accountants at CPA firms that don't know how to read a cash flow statement.
That's
Truth.
hard. That's a sad thing.
It is a sad thing. It is a sad thing. But if coming from the CPA world, you're taught how to put them together. Hey, I just built it. I don't understand what it's telling me. That's not
Yeah.
always the there's a lot of accountants that are not business minded. But and also learning what a 13-week cash flow is. And that's a tool that we use in the turnaround business. You're basically trying to project out what your expenses are 13 weeks in advance, knowing what kind of revenue you need to bring in to meet that demand and be able to pay your debt service, and sticking to that. So it's kind of like a forecast budget in a way, but it's just a tool to manage your cash flow. Let's see. There's a lot of different things I would explain, but yeah, top 3. Get experience managing people, know how to read a cash flow statement and a financial statement. And then also just know what it is you want in life. Because, for instance, this is an easy example. My wife and I are in the real estate business, and we actually both are realtors, but we flip houses and sell our own stuff. But, working with clients, if you don't want to work on the weekends and at nights and on holidays and while you're on a dinner date with your wife, don't be a realtor. So, if they say, I want to go into this and this is what I want my life to look like, I'm going to say, well, you need to rethink that.
Yeah. Yeah. So, that's buying a business from for your first, I don't own a business to buying a business. I think the folks listening to this podcast might be more interested as I want to do an acquisition. I
Yes.
already have a business.
Right.
And when you're advising people there, what kind of advice would you give them about how to make sure their acquisition doesn't fail on them?
Well, due diligence is key. Asking lots of questions. I mean,
Okay, but what sort of questions and what should I be drilling down on?
prove out their revenue. I mean, you can do an easy thing called a proof of cash. So
Yep.
basically, you're taking deposits and then you're subtracting out and adding beginning, ending AR and some other little things. It gets a little more complicated than that, but from a high level, you can get an accountant to help you with this as well. But you come up with proving out what's the actual revenue in that business.
Yep.
I actually look at balance sheet accounts, particularly assets, because assets are a debit in accounting world, and so are expenses. Sometimes people will take those debits to expenses and shove them into an asset. I saw one point where somebody had shoved $1 million worth of expenses into, I guess it was like construction and process, work in process type account.
Mm-hmm.
So what they've done basically is they've shoved all these expenses that weren't supposed to be in that construction and process account, and they weren't depreciating that either, because construction in progress and work in progress, those are not depreciated accounts. So they're puffing up their financial statements doing that. Asking lots of questions and getting an attorney involved to look at, to see if there are any liens on the business, any kind of legal issues the company's dealing with, because they could very well be your legal issue once you get involved. You want to make sure that there's some synergies, like buying this business. is going to add value because of whatever reason. I mean, you know, I was in the ready mix concrete business, and so that was a fun business. So we had ready
Dusty.
mix, yeah, we had ready mix plants, we had concrete block plants, sand quarry, lumber mill, and but we went out and bought more concrete block plants, and we went out and bought more ready mix plants. Part of our strategy, though, on that was that was a value add to us, is these were on the edges of our market, and we didn't want another certain competitors to come in and buy them out. So we wanted to get in there and get them, and so we could secure our market a little better. So that was one of the strategic reasons why we decided to do that. And when you have more businesses, if done the right way, and you've got the business has good margins in it that can support you, if done the right way, you get a lot of economies of scale, because you have certain fixed costs that don't end up going up just because you add on new plants, right? So our bottom line, our EBITDA as a percentage of revenue was going up. Now, we also were very insane about numbers.
That's the basis for a strategic buy. If I'm a strategic acquirer, that means I'm coming to buy your business, and I can make a bunch of your overhead disappear.
Right.
Because I already have that stuff in place. The thing I found, which is really true in acquisitions, where I think most businesses fail, is that most businesses focus on exactly what you've been talking about, and they ignore the culture compatibility between the two companies. And that's where I see almost all acquisitions fail, is I'm buying your business, and we have a belief system about how businesses should run over here, and you have the acquired business has a different set of belief systems. Unless I have a strategy in place before I buy the business and how to get that culture to become my culture really fast, there's a good chance I'm going to spend way too much time, and I mean years, fighting between the two cultures to get one or another to take over for it. And it's the main reason that you get these zombie businesses out there, especially true in the private equity world. They'll buy a business, and they're going to come in and think that the selling owner, who they're retaining at least for a period of time, is going to become able to take instructions from them. And I'll tell you one thing about selling owners: they're not good employees. They've never been employees.
That's right.
They're lousy employees.
That's right.
So unless you have a methodology, and Cisco Systems, I think, did this better than anybody. They would come in, Ciscoize your business in 24 hours. Anybody who could not or would not, or they thought would not be a part of their business, they were gone the first day. There was no said, we're going to try to make you change. They said, no, that doesn't work. This is how it works. And they've done they've done 300 or 400 acquisitions. Most of them have been very successful.
Absolutely, and I think that point is very well received, and it's a good point. The way we had a strategy around that, and we would, when we bought a plant, we spent a lot of time there. We'd have people from other plants go to that plant and get them indoctrinated, if you will, quickly. And we there was no fuss. I mean, if you didn't get on board, we have somebody else that's looking for a good job. We paid well too. So we did a really good job at paying. We did a lot of good bonuses and incentives, and we were able to do that by looking at our numbers. We had KPIs that would refresh instantly. Like every 5 minutes, the data would update, and we're looking at GPS. We're looking at our GPS tracking systems would tell us how long a driver was on the job after he finished pouring. The sensors would know how long it was taking him to pour out the concrete, and we would mix that with the timekeeping data and all kinds of stuff. We could tell you how profitable a single driver out of 300 drivers. I could tell you how profitable each driver was. I could tell you how profitable our customer was.
You guys were really unusual then. Even big companies don't do a good job of that.
We did an
Um,
excellent job of that. And that was one of my strengths. I'm actually a data guy. I nerd out on
yeah,
this stuff. I'm a big Power BI guy.
well, that's kind of a good thing. That was one of the reasons your acquisitions worked. The other thing is, I bet you guys didn't overpay.
No, we wouldn't overpay. Sometimes there's a strategy for overpaying a little bit, especially if you're trying to keep a big competitor out of your market. But you don't want to do that. And you definitely want to make sure the margins are there, because I tell you, going up on price and somebody is a tough thing. When we took that business over, 5 or 6 years ago, it was a little over, somewhere around 5 years ago. That they had not been keeping up. They hadn't been increasing their revenues. So that's a big deal. You've got to increase your revenues. You got to look at your costs every year. If you give your people raises, well, then you got to raise your rates so you can
Yeah,
offset that and keep your margin the same. And it would be unreasonable for a customer to argue with that.
yeah. No, I agree. The thing I see a lot is that in almost every industry, there's what I call the bottom scum feeder M&A person who wants to represent both sides of the deal,
Yep.
puts a bunch of buyer finance in there, overvalues the business because they're getting their fee on what the price was that was negotiated, not the price that actually gets paid. And these deals completely fall apart. The wealth management world has two people that do that. And it's just really, in my opinion, it's unethical.
Right.
And you either represent one side or the other, but not both. And you can't get paid by both parties because who you're working for at that time.
Absolutely. And a big major change that I would like to make in this industry is to have more of a sharing arrangement where, like in real estate, you have a buying agent and a selling agent. I think the brokers need to have agency agreements, and they need to share the fee. So you have somebody that's got a vested interest in each side. Because I know sometimes, selling brokers, not all of them, but some of them, they could just be feeding you a bunch of BS. Their responsibility is to their seller and not to the buyer. But the buyer is made to believe, oh well, this guy's got my best interest at heart. Or he may not. So
Well, you need to have the buyer should represent representation also.
yeah,
If
and
buyer brokers play a big deal, in my opinion, for someone who's never bought a business.
yeah, and you need a team. You need a CPA, you need an attorney, you need an advisor, and then also a big piece of your team, which a lot of people don't think of, is either your spouse or your significant other. Um, it that's a big deal. And if you don't have a spouse or a significant other, it could be a best friend that knows you really well. It's not the kind of person who's going to try to squash your dreams. Uh, but yeah, having a good team is crucial, because so I would never suggest anybody just go out there and try to buy a business on their own. You need a team, and that's part of what we're doing. We're trying to help people understand. We're introducing people to experts in the M&A world who understand this stuff, and give them some scenarios and stories and things that are going to help them along their journey.
Cool. Hey, Philip, unfortunately, we are out of time.
Man,
And I'm going to bet, yeah,
I was
I'm going
enjoying
to
it.
bet. I'm going to bet there's going to be some folks who are going to want to find you and find out more about what you do and all that kind of good stuff. So how do they go about doing that?
Absolutely. So they can visit me at www.thebusinessminer.com/cash flow code. And for your audience, they'll be able to go out there and download a template, an LOI template, and also be able to schedule a call with me. So if you want a free consultation, 30 minutes, it's free for a limited time. Just go out there and take advantage of that.
Cool. That sounds like a good idea. And I have two things I would like you to do. The first, I ask after every podcast, which is please, 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 go to wherever you're listening to this podcast and give us an honest rating review. If you love the show, tell us. If you hate the show, say that also, but just give us a review, please. And the second is I developed this thing, I don't know, probably close to 20 years ago. And I sort of did as a joke because a friend of mine who was in the estate planning business came out with the periodic table of estate planning elements. And I said, well, gee, business owners have a zillion tactics and strategies that they can do to make their business more sustainable. that's economically sustainable and personally sustainable. So I put together my own periodic table of business elements. And again, it's really easy. You just go to www.stage2planning.com/periodic. That's www.stage2planning.com/periodic. And this is Josh Patrick. We're with Philip Arthurs. You're at Cracking the Cashflow Code. Thanks a lot for stopping by. I hope to see you back here really soon.